Good afternoon. Today we are discussing a specific financial maneuver known as Norbert's Gambit. This is a method used by investors to convert Canadian dollars to US dollars, or vice versa, within a self-directed brokerage account while minimizing the foreign exchange premiums typically charged by financial institutions. Our goal today is to explain the mechanics, the costs, and the risks involved so that you have a complete understanding of how the process functions in a real market environment. Before we begin, it is important to state that this presentation is for educational purposes only and does not constitute financial, legal, or tax advice. To understand why Norbert's Gambit exists, we must first look at how currency is typically exchanged. When you ask a bank to convert currency, they generally apply a spread. This is the difference between the market exchange rate and the rate they offer you, which is like a hidden markup fee. Banks offer you a slightly worse rate than the market rate. This spread often ranges from 1.5% to 2.5% or more. For an investor converting $10,000, a 2% spread represents a cost of $200. Norbert's Gambit is a strategic alternative designed to bypass this spread by using the plumbing of the stock market to move value across currency lines. The mechanism of Norbert's Gambit relies on dual-listed securities. These are stocks or ETFs that trade on both the Toronto Stock Exchange in Canadian dollars and on American exchanges in US dollars. Because the underlying asset is the same, it holds the same intrinsic value regardless of which currency it is priced in. The most common instrument used for this is the Horizons USD Cash Maximizer ETF, which trades under the ticker DLR on the TSX. The process begins by purchasing shares of a dual-listed security in the currency you currently hold. For example, if you have Canadian dollars and want US dollars, you would buy shares of DLR.TO on the Toronto Stock Exchange in your Canadian account. At this point, you have exchanged your cash for an equity position. Once the purchase is complete, you may move those shares from your Canadian account to your US account. In technical terms, this is called journaling the shares. You are not selling the shares and buying them again. Rather, you are instructing your broker to redefine the shares you already own as their US equivalent, which trades under the ticker DLR.U.TO. Depending on your brokerage, this can sometimes be done online, but often requires a brief phone call or a secure message to the support team. There is a critical timing element to consider: settlement. In North American markets, trades typically take 1 to 2 business days to settle. Most brokerages require the initial purchase to settle before they can complete the journaling process. Once the shares are successfully journaled to the US side of your account, you simply sell them. Because you are selling the US version of the fund, the proceeds of the sale will be deposited into your account as US dollars. It is a misconception to call Norbert's Gambit free. It is simply low cost. Your total expenses consist of 2 trading commissions, one to buy and one to sell, plus the bid-ask spread of the ETF itself. The bid-ask spread is the difference between the highest price a buyer will pay and the lowest price a seller will accept. For a fund like DLR, this spread is usually very thin, often around 1 or 2 cents per share. For larger sums of money, these combined costs are significantly lower than the 2% spread charged by a bank. While the process is mechanically sound, it is not without risk. The primary risk is market volatility. During the days it takes for your initial trade to settle and the shares to be journaled, the exchange rate or the price of the ETF could move against you. If the Canadian dollar strengthens significantly during those 2 days, the value of your US dollar proceeds will be lower than expected. Furthermore, some discount brokerages may charge an administrative fee for journaling, or they may have policies that make the process more cumbersome. In summary, Norbert's Gambit is a precise tool for investors looking to optimize their currency conversion. It requires having an account at a financial institution that allows for both CAD and USD sub-accounts, a dual-listed security, and the patience to wait for trade settlement. While it can save a significant amount in fees on large transfers, the user must account for trading commissions, the bid-ask spread, and the potential for market fluctuations during the settlement period. Accuracy and execution is paramount to ensuring the maneuver remains cost-effective. If you're not sure how Norbert's Gambit works, and would like someone to walk through this with you step by step, or even do it for you, I'm happy to help. My email is in the description below. I hope this video was informative to you. Have a great day, everyone.